If I ask people what is the most complicated part of managing your personal finance, mostly they'll come out and say it is investing. They have few complicated questions for which they are not getting proper answer. Is it a good time to invest in stocks? Which fund managers will beat the market? What is a perfect asset allocation? The financial market is a complex system, agreed. It doesn't mean that it requires a complex strategy. In fact, it is a false premise. This false premise is the driving force behind many investment mistakes. That is why we have investment expert Chirag Patel with us to take us through why investing looks so complicated and how to make it simpler. Chirag, over to you.
All of you might have heard about this incidence. It's a Hudson River incidence. So it's a story where a plane took off from an airport in US, and immediately after it took off, a flock of Canadian goose got into both the engines, and the both engines stopped working. Now, when the both engines stop working, you have to float in the air, and the heavy aeroplane can't float in the air, right? So the pilot name was Sully, and he was talking to the air traffic controller that, what I can do for it now. What is the remedial action I can do? So the air traffic control asked him to get into the nearest airport, right? But the nearest airport is also 20 miles away. Right? So what he can do? So they asked him whether you can reach there or not by floating in the air. So what Sully did, Sully landed that plane onto Hudson River, right? And all the passenger got saved and evacuated. Why he took this decision and why he took it very fast? The reason he did not use a complex algorithm. What he used very simple algorithm, because the tower near the nearest airport was actually going down on his windshield. So when he was looking from his windshield, the tower is going up in the upward direction. It means that the plane is falling very fast. And if something is getting, upward from your vision, it means you can't reach there by floating. So by looking at that simple observation, he took the decision and he immediately landed the plane on the Hudson River, and that survived some 122 passenger at that time. And so he did not use any complex algorithm. If he would have used those complex algorithm, he might be into situation called paralysis of analysis. Too much paralysis leads to analysis, and after that, too much analysis leads to paralysis, and after that, it would be very late to save all the passenger and save the entire crew. So this is what is the simple phenomenon that has been used, and there are many such real life examples. So I will share few more examples so things would get better for you. So generally, this is what a market outlook con call will feel like to the investor, because we talk about Russia, we talk about China, we talk about crude oil, we talk about Fed rate, we talk about exchange rate. Now we talk about China-Taiwan issue, right? We talk about Indian fiscal deficit, we talk about inflation. And at the ultimately, what we conclude, the market will remain volatile for the short term, and it will be bullish for the long term. That is what is the conclusion of all the market outlook con call that I have delivered and I have heard. Still, people listen this commentary for one entire hour, and finally they conclude it will remain volatile for the long term, and it is good in the long run. So that is what is the issue, that after doing so much analysis, you are concluding the same thing all the time. What does it mean? In long run, if the fundamental is okay, you are going to get the return. But in short term, because of so many problems, the market will remain volatile. And this is the story all the time. Because if there is living being, if there is an economy, there may be some problem around the world. You can't have a zero problem across the world and across all the asset class, across all the macro parameter, or across everything. You can't have a world without any problem. And what is the biggest problem is we want to predict the markets, right? And that is what is the biggest challenge. And doing prediction, 50% time you will go right, 50% time you will go wrong. But the problem is when you go wrong, the the cost of that loss is so high than what you have made out of your 50% right prediction. So that is what is the issue. So if you see, the market is very simple, right? Just a second. So how the Sensex have moved from 2004 to till date. So it is long 15 years, or sorry, long 18 years data. So this blue line is a Sensex, and this green line, light green line, is Sensex profit. So if you see, in a long run, both are moving together, but in short run, there are some mismatches, right? What are those mismatches? For example, in 2007, the Sensex moved ahead of its earning because of positive sentiments. When so many people think that everything is very good, when the roads are clear, everyone was driving so fast. And when everyone's driving so flat, the market has moved beyond its earning. And when it happens, so the actual is, the markets are above their fundamental. This is called overvalued market, or we can say very positive sentiment, because there is a clear road and there is no traffic, there is no problem. So everybody was driving so fast, and finally the subprime crisis happened and market corrected. And when market correct, it don't stop at the fair value. So when these two lines meet each other, it is called fairly valued market. They don't stop at the fair value. At that time, the physics law work. Action and reaction are equal and opposite, right? So the prices was falling so fast and so steep that the market has become undervalued, right? So because the earning has not fallen that much because of subprime issue, but the market has fallen too much, and this is called undervalued market. So if you invest during undervalued market, you will make money. If you index during overvalued market, you will make lesser return. That is what is then the average return, right? So on an average, people will make 15% return. Those who invest more during overvalued market, they will make 12% kind of return on an average. And those invested more during the undervalued market, they may probably make 2% higher return, is 17%. So 15% return of a market, if you don't do anything, you will make. But based on your behavior, either you can make 12% return or you can make 17% return, right? So this is what is the market is all about. But because of all this short-term issue, it can either create opportunity to lose money, or it will either create opportunity to make money, right? So if you see what has happened from October to till date. So in October 2021, the market was overvalued as compared to its earning. So what I was thinking, that market will correct by some 20-25%, but market corrected by 15% only. Why? Because the earning has also improved during this period, and both lines are just meeting each other at the end of June 2022, right? So this is very simple, right? So these lines are always going to be upward trending, and why it is so, that I'll explain later. So again, there is an example. So we think that wealth creation requires a lot of analysis and a lot of graphs, right? So these are the two pictures. If anyone can put into the chat box, there is a left picture on the left hand side. There are so many terminals, and there is a picture on right hand side where there isn't a single computer screen. People who are sitting in this room, who has created more wealth for their investor, right? The left side is actually the room of Lehman Brothers, and the right side is the room of Charlie Munger and Warren Buffett, right? There are so many books. There isn't any computer. They read a lot rather than doing. So they are trying to the left hand side picture is not about Lehman Brothers. Is most of the people, they're trying to predict the short term market movement, and nobody can predict it, right? And that is what you should accept first, right? From bottom of your heart, that we can't predict the market in short run, right? So that is what it is. So again, there is one more example. This is a complete, a very old Japanese company's case, where they used to manufacture a soap, right? It is a real life case. So what was happening when they are packaging those soaps into a bigger soap box? Some soap boxes were remaining empty. So it is a story of an empty soap box. So when a consumer was buying a dozen soaps, what he used to found, there are some soap boxes were empty. So which was creating dissatisfaction among the consumer, that you are cheating the investor, and which is actually the case for a goodwill loss case for the company. And so what they tried to do, so they tried to fix this problem by various means. So they tried to put up a lesser machine. So if they put the lesser machine and across the assembly, and those who are empty, right, the robotic arm will throw those empty boxes out of the assembly line, so it would not go to the main packaging line. So what they did is this, but it was very costly solution, and it is not meeting the cost benefit analysis. So one of the factory workers suggested them, why you are wasting so much time on constructing this new facility on the assembly line? You just need to put a industrial fan across the assembly line. So if the box is empty, definitely it has to be lighter, and if it is a lighter box, then and there is no swap inside, the fan will automatically push it out the assembly. So you just need to put a fan across in front of the assembly line, so it will automatically throw the empty soap box outside the assembly line. So you do not need to put so much capital and effort to do it, right? So there is again a problem to a simple solution to a complex problem. Now this is what, by looking at this picture, right, which is the better aim, left one side or a right one side? But by looking at a naked eye, you can see that a right one is a better aim. But what a complex model could have thrown you a result. For if I put a very complex model, which is using so many parameters to justify whether the asset class is undervalued or overvalued, the actual model could have done this, which is on the next slide. So the left aim, right, would be like this. So when there are so many parameters, what will this parameter will do? They are internally correlated, and then they average it out, right? So in this, if you see, left is a better aim because they are more closer to the center, and they are very much concentrated also, right? But a complex model would have averaged out all these parameters and put it over here, which we have seen in the last slide. But a complex problem, a complex algorithm would have averaged it out, and since all are disposed equally from the center, it would have put it in the middle, right? And so by a complex algorithm would have predicted the right is the better aim, and the left is a not so much better aim. But by looking at this picture, where where the aimer has actually shoot is actually the left hand side is a better aim, not the right one. But a complex algorithm would have predicted this one, because number one, generally when we build any complex equation, we get overbought to that idea, and we have done so much data crunching, and we have used so many parameters. It gives you us a false illusion that this will give us a better picture, but actually this has averaged out those probability, and it would have give you a completely wrong picture, and you are betting very heavily on those wrong picture because you have done so much analysis onto it. So sometime when we read so much newspaper, so much data analysis, so much data, we also average out this kind of thing. And because we have now read so much about it, we have done so much analysis, we have done so much parameter, we have gone through so many macro indicators, we construct a bias, right, called an overconfidence bias. And when we have overconfidence bias, we bet more money on wrong ideas, and that's why we end up losing more money, right? So that is what is the problem with the complex algorithm. This is again one of the bias, which is called a sampling error or a survivorship bias. So there was a mathematician during the World War II. The German used to, was using anti-aircraft missiles to an anti-aircraft gun to shot down the Britishers' aircraft, fighter jets, right? So what they did, so they tried to build a shield. So the plane was looking like this. They tried to build a shield so that they can protect them against the anti-aircraft gun, right? But the problem with those shield, if they cover and the entire fighter jet, it increased the weight of the fighter jet. So it has to carry more fuel, which is not possible. It can't flew for a long time. That is also problematic in the situation of war because you need to flew longer. So they decided we do not fix the shield on the all part of the aircraft, but we'll shield it to the selected part. So they did an analysis on the of the aircraft which has returned from the war, right? So what they found, there are more shotguns on the wings and on the tail. So we have to fix the shield over this part, right? So one of the mathematics, his name is I think Linder or what, I forgot the name. So one of the mathematician actually objected that no, you should you should put the shield over the part of the engine and not towards the tail and the wings. So everyone asked because these are the part which are got more affected because of the shots or the anti-aircraft gun. So what was his conclusion? That those who had been hit on the engine and on the cockpit has never came back. Since the wings and the tail can take more of the guns and can actually withstand all those kind of aircraft gun shots, they can actually come back. But those who got hit at the engine or at the cockpit has actually not came back from the war. So this is called survivorship bias. Those who we are just looking at those data which have survived. This is called survivorship bias. So generally, this kind of things will happen, right? So at the case of during COVID crisis, why many people could not invest? Because we are looking at the death of due to COVID, and which was a very high number at that point of time. But in the month of May 2020, there was an analysis. More people died because of diarrhea than COVID in India, because no people track, and more people die because of the disease which they got because of diabetes. So actually, diabetes is more causing more casualty than the problem that we were witnessing at that point of time. But the data were not available and they are not that much stark. So because those data were available, we are crunching those data a lot. We think this is a lot more big problem than anything else. But if you believe me, our food habits are more dangerous than COVID, right? Our eating habits are more dangerous because they get us diabetes, they get us heart attacks, and which is much more problematic than the COVID problem. But what data at that time was having was the availability bias. We only have those data available which are visible on our TV screen. So that is what are the various kind of biases that we'll go through. And that's why sometimes we may end up making wrong decision because we try to overcomplicated things.
Thanks for your insightful answer. If you have any questions related to this or any other investment options or related to your financial goals, feel free to book a free appointment with our financial planner. The link to the free booking is given in the description below this video. Also, will you be interested to attend insightful investment webinars? Then feel free to register for our upcoming insightful enlightening investment webinar, and it is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give a thumbs up. Also share it in your social circle. If you are not subscribed to our YouTube channel so far, please subscribe now. Bye.